Welcome to The Explainer. Today, we're going to tackle portfolio management, but we're doing it a little differently. We are going to break it down like a top-tier consultant, giving you a structured, a MISI framework that's mutually exclusive, collectively exhaustive. This isn't just theory, all right? This is a real blueprint for action. Okay, so let's just jump right in with the answer first. At its absolute core, this is what portfolio management is all about. It's not about randomly picking stocks. No way. It's a continuous, disciplined process. It's really the art and the science of getting your money to work for you towards a very specific goal, all while you manage exactly how much risk you're comfortable with. So here's our game plan. First, we'll nail down the foundational principle. Then we'll deconstruct it into its key pieces, look at different management styles and actual strategies, and then we'll get real about the challenges before we land on the bottom line, what you can actually do. Let's get started. Let's start with the big one, the governing thought behind every single investment decision you are ever going to make. This is like the prime directive for your entire portfolio. This is the one big trade-off you just can't escape in investing. Every single decision lives somewhere on this spectrum. You've got the rocket fuel of high potential returns on one side, but that always comes with more risk. And on the other side, you've got the shield of safety and stability, which, usually means lower growth. The whole discipline of portfolio management is about intentionally picking your spot on that line, the one that really fits your goals and, frankly, your stomach for those market swings. Okay, now let's break this whole thing down into its three essential building blocks. Using that consultant's approach we talked about, these are the MISI components. They're separate, but together they cover everything. This is your portfolio's blueprint. These are the three pillars, and you gotta understand they work in a continuous cycle. First, asset allocation. That sets your big picture strategy. Second, diversification helps reduce your risk within that strategy. And third, you've got rebalancing, and this is so important. It's the discipline of hitting the reset button on your portfolio to get back to your targets. Because as some things grow faster than others, your mix gets all out of whack. Rebalancing forces you to sell high and buy low to stay on track. Let's look at each one. First up, asset allocation. And let me tell you, this is probably the single most important decision you're going to make. It's your strategic blueprint. This chart here shows a pretty classic moderate portfolio. 60% in stocks for that growth, 30% in bonds for stability and income, and then 10% in cash for, liquidity and safety. This mix right here is the number one driver of both your risk and your return. Now, what's really cool here is how your personal risk tolerance directly shapes this mix. It's like a mirror of your financial personality. So, are you an aggressive investor? Are you comfortable with the ups and downs for a shot at higher growth? Well, then you'd lean heavily into stocks. Or are you more of a conservative investor, where protecting your money is job number one? Then bonds and cash are going to be your best friends. Your asset allocation is your strategy, plain and simple. All right, let's move on to pillar number 2, diversification. So if asset allocation is the big picture, the mix of stocks and bonds, diversification is what you do inside those buckets. It's that classic advice, right? Don't put all your eggs in one basket. But real, effective diversification goes way deeper. It means owning stocks in different industries, tech, healthcare, you name it, and in different parts of the world, like the US, Europe, and emerging markets. This is what helps protect your portfolio if any single company or country has a bad year. Okay, so with those foundational elements understood, we're now facing a really key strategic choice. You've got the blueprint, but now who's the architect? Who's the builder? How hands-on or hands-off do you really want to be? This slide really illustrates the first big decision, and it's a fundamental philosophical choice. On the left, you've got active management. This is the belief that a manager, through skill and research, can actually outperform the market average. It's hands-on, and it definitely comes with higher fees. On the right, you have passive management. This approach basically says, hey, it's incredibly hard to consistently beat the market, so let's just try to match it. You do that by holding a broad market index. It's more of a set-it-forget-it style with much, much lower costs. Now, to really get what active management is about, you have to understand this concept of alpha. Alpha is like the holy grail for active managers. So if the S&P 500 returns 10% in a year and your fund manager gets you 12%, they've generated 2% of alpha. That is their whole value proposition. They get paid those higher fees to hunt for that alpha. The great debate in finance, though, is whether most active managers can actually deliver it consistently, especially if you factor in their fees. The second big choice is all about control. With a discretionary account, you're pretty much hiring a CEO for your portfolio. You set the strategy, and then they execute it. They make trades without calling you for every little thing. Now, with a non-discretionary account, your advisor's more like a consultant. They can recommend a trade, but you, and only you, have to give the final yes or no for every single transaction. Okay, so we've covered the principles and the big strategic choices. Now, let's see how these concepts actually combine into real, actionable strategies. Each one tailored to different goals and different kinds of people. First step, we've got the aggressive strategy. This is for the investor who's got a long time horizon and a high tolerance for risk. Yeah, this one is all about prioritizing growth over safety. That means a portfolio that's heavy on stocks, often in high growth areas like tech, and it means accepting that you're going to see some significant swings in value, all in the pursuit of those potentially market-beating returns. Now, on the complete other end of the spectrum, we have the conservative strategy. This is all about preserving your capital. Think about someone who's maybe getting close to retirement. For them, the main goal is just minimizing the risk of losing money. So that portfolio is going to be weighted heavily towards lower risk things like high quality bonds and stable blue chip stocks. You're very clearly trading that high growth potential for stability and really for peace of mind. And now for a little dose of reality. Because a perfect strategy on paper still has to deal with the messiness and the friction of the real world. No portfolio just exists in a perfect little bubble. Every single investor has to deal with these things. Markets are always going to be volatile. Your own life and your goals are definitely going to change. Tax laws can shift. And then there's the silent drag on performance, fees. Let's just put a number on this because it's pretty shocking. A 1% fee, it sounds so small, right? Harmless. But it's like a termite silently eating away at your future wealth. So check this out. On a $100,000 portfolio that's growing at 7% a year, that 1% fee doesn't just cost you $30,000 over 30 years. No, it costs you nearly $280,000 in your final portfolio value. That is the true cost of that small fee, $250,000. So costs don't just matter. In the long run, they are everything. We've covered the what, the how, and the why. We've deconstructed the whole problem like a consultant. But now for the most important part, the so what. Let's boil all of this down into your key takeaways. This is really the framework, boiled down into a 4-step process. First, you have to know yourself. What are your goals and what's your real risk tolerance? Second, choose your path. Are you going to go active or passive? Third, build with discipline using those 3 key elements: allocate, diversify, and rebalance. And finally, and this is key, remember this is not a one-time thing. You have to review your plan regularly and adjust it as the markets and your own life inevitably change. And we'll just end on this thought. I want you to stop thinking of this as just investing. Start thinking of it as the most important long-term project you will ever manage. It needs a clear strategy, a disciplined process, and consistent oversight. The principles are clear. So the only question left is, how will you manage it?